Hey guys, trust everybody is doing well and staying safe. In this video, I'm trying to cover a tool that some of you might know, but I believe a lot of people have no idea about this tool. And despite all the quantitative modeling I try to do for option strategies in Python and Excel, I think it is still my go-to tool for most of my simple checking, especially if I'm looking for a quick update or a quick scenarios about a position, and it helps a lot. So if you're an option expert, please skip this video. This is not for you. If you are an option buyer or seller and you run into scenarios where you see that price change in option and you see, oh, I didn't see this coming. The stock price has moved in the direction I wanted, but the option has not appreciated or changed too much according to my estimate. So you always want to understand, like, is there a tool which I can use which can give me a simple idea that if certain things change, how my option pricing is going to change. So let's look into it. So go to Google and search for CBOE eye volatility calculator. And you will see this option of options calculator CBOE global market. You can go to that. You can go to Google and search for CBOE eye volatility calculator. And you'll get this option of eye volatility options calculator. And if you go to this option, there is something called basic calculator. If you have a login, that's perfect. If you do not have a login, then click the option of join free. And here you can go and fill all the information. I'm pretty sure every one of you knows how to do that. So I will skip that part and we'll move to the next part then. So once you will log in and you will have an active login ID, you will eventually land on this page. And this page will actually show you some kind of a simple layout that you can use, and it can actually fetch the information from the market itself. Please be advised, I'm not saying that you should buy this option or you should sell this option. I'm only trying to tell here that if you have an option, how do you actually value it? So let's say by default there is MSFT and I just press go here and it will tell me exactly at this particular point. This is an American option. The stock price is 295, the strike price is 295. The latest option chain is at February 18, days to expiration, volatility, interest rate is pricing, and based on that, what is the value of the option? That is the call, which is $4.6 and the put is $5.19. Now, so for example, Microsoft is one option that you are interested. And say in this particular case, you believe that Microsoft has a room to grow. And you say, I believe that Microsoft in a year can grow substantially. In that particular case, I go and I select an option chain, which is of March 17, 2023. So now you see that once you have selected this option, your days to expiration has changed. The volatility has also changed according to this. You don't have to find this information. It it fetches this information based on the last trading day closing. Okay. Of course, if you expect the interest rate to rise and during that time, you can definitely increase the interest rate. So let's say the current price for Microsoft is 295. I want to buy this option The expiration day is 397. That means when you buy an option, you take it's going up, it's going down, or it's going to stay flat, and you decide like what's the time interval look like. So there are certain decisions you need to make on that part. Okay, now this is the interest rate. We say that interest rate is gonna increase. For our purpose, let's say we make this interest rate 1.5, but at this particular point it doesn't make too much difference. Now, and the reason for that is because this it's not what you think is the interest rate, it's what market think is the interest rate, and that's how it is. It's a bit different. So based on this, it is telling you now that if I take this interest rate, the option value for call is $36. So that means you will pay $36 to buy this option, which is to be executed 1 year down the line almost, and you will be able to control 100 shares from one contract. So how much you will be paying? Eventually, you will be paying $36, let's say roughly over 100. So that means that particular option will cost you around $25 plus some trading cost along with it. So you know exactly like, okay, this is the money I am going to put on table if I buy this option. So, and you know this is a premium. This is not, you're not buying share. So that means this is the money you can lose altogether. Now, if after that particular year, the stock price is below 295, you lose your $3,600. If at that particular point your stock price is above 295, so your total gain at that particular point is basically whatever is the stock price minus 295. So since you are paying $36, for you the effective break even in that particular case is 295 plus 36. Okay, that means if the stock is below $332, you will be at loss. So for example, if a stock is at 317 and you subtract the 295 out of it, that's the stock price, then you will make 22. So you invested in this option $36 and you actually only made 22. Now why this is important to understand is that when you buy options from a speculation point of view, sometimes you fail to calculate how the numbers will go up and down. But let's take a scenario that your strike price changes. Okay, sorry, the price changes on the stock price. So now let us take a scenario that in 300 days from now, okay, that means I remove 300 from 397, okay, and you will notice it turned into flex. That means now you are changing things. Your price change is 400. That means Microsoft goes in 300 days to a price of $400. Okay, you can play with volatility and interest rate. At that particular point, let's say I assume that interest rate at that particular point will be 1.5, and then I calculate the option price. So you see now my option is $106. So it is telling me that if certain scenarios exist and can play, my option can, this will be the option value. So you spent $36 and your option value at that particular point after 300 days from now is $106. So that is giving you some sort of sanity, okay, how my option values can change. What you are doing on the call, in same way you can do it on the put side also. So let's play this for a while. So let's say my option price at that particular time is for example, say $350. Okay, and I assume the 1.5 and it's $59. So now you can see, you know how much you are spending when you are buying this option and what this option would look like in a certain scenario. Okay, now there are a few things you need to understand that this tool you should also use to understand how options change. So for example, I'm changing nothing, but I'm now changing days of expiration. And you will see that 59 has turned into 55. So it is telling you roughly that there is $4 of time premium that is embedded in the option price between 97 days of expiry versus 6 days of expiry. So it is telling you that option price decay on the time axis, or the time premium of the option price decays as we move closer to the expiration date. And that makes sense, because if you have longer expiration, that means you have longer room to go for stock to go up or stock to go down. Also, the volatility could be a function that is important to check. So there are historical charts that you can look at. You can look your trading window sometime, that how the volatility look like. Now let's take another scenario. And for example, at this particular point, let's say I want to check Tesla. Okay. And I go to Tesla, and now I have Tesla chain. And see, it brings everything on its own. You don't have to do anything about it, and that's the beauty of it. So now the point for me is somebody who is bullish in Tesla and say that Tesla is at 860, but I believe Tesla will go at least above $1,000 in a year from now. So what we do is we take a strike price of $1,000, and we want to understand that what will be the value of that option as of today. And it's telling the theoretical value of that option is 173. That means if you buy that option today at 173 or $174 based on this calculation, it is telling you that in order to have a break even or to make money over your investment, the stock price after 1 year has to be more than $1,034. So now this is giving you at least some sense that do you really believe that it is going to be above that price, and how much it is going to be above. Because if it is below 860 at that particular time, you would lose all of your money. And since we are talking that options you do in a contract of 100, that means you will be buying 100 shares in a contract. So 173 into 100 or 174 into 100 is that one contract will cost you around $17,400. So you will be risking $17,400 for this exercise, and you could lose all of it if the stock price is below 860. Now the beauty is this is if you buy shares, let's say 100 shares, and for whatever reasons company decline more, then you can lose a lot more. So if you take options from a risk management point of view, it's a whole different story. That means it is telling you that you will not lose more than $17,400. And this is what people miscalculate in options. Options are optionality. It's a premium. It's a privilege. And that privilege you buy with a certain money, whether it's on call or put, and you can actually lose all of it. Okay, so when the options go bust, yeah, you will. So that's why if you are going all in on options or YOLOing in options, yeah, you are up for a lot of pain. So now coming back to this exercise, I say that price is 860. I'm trying to buy strike price at 1,000, and my days of expiration is this much, volatility this much, interest rate is this much. So let's say you buy this option. So 300 days from now, let's say the price of Tesla is $1,500. In that particular case, your option value will be $515. So depending on what parameters you have taken, you can see that you have spent some 170 or whatever the price on that particular day for that particular option. And if there is a move quite significant, you can make $515 on that call option. Now this is important to understand that if you own Tesla share and it goes from 860 to 1,500, in that particular case, your gains are roughly of around 74%. Since you bought option and option call value has gone to 515 from odd 170, so your gain in this particular case is like 3 times, like you got almost like 200% of gain. But nothing is free. So what you are getting here is, so you deployed a far less capital that you needed to control that many Tesla share. So you kind of created a leveraging effect on its own without actually going or taking any margin. However, on the other side, if stock price stays below 1034, you lose money. And if the stock price is below 860, you lose it all. But on the other hand, if you are holding share, you can use the same shares to actually sell covered calls over it, and even if it is decline, you lose money, but you still hold the share. That's the difference. So there are two different risk management strategies here are at play. So you better be aware of these things. So interest rate, I mean the kind of interest rate we are looking over the year. For example, if I take from anything from 0, and if you take anything from, let's say, 5, I think 5 is too much, let's take 3, you will see it's not a big deal we are talking about here. Okay, so given the, so there is a in the Black-Scholes or any option pricing calculation you do, you take interest rate as an input, but given the other parameters, I think that sometimes the roles of interest rate is not that much. Okay, so now let us apply something with Palantir. Okay, and at this particular point, sorry, I just need to press the go. So now it is telling that at this particular point, Palantir is 13.13. Okay, and again, we don't know what the Palantir price will look like in a long term. Okay, we're just trying to see how it will look like, and we say that, okay, we'll say that Palantir is a good buy. Okay, in that particular case, we're thinking of buying Leap, for example, and I say I want to buy Leap. Okay, and then I say that if I buy a Leap that is of strike price 13, days to expiration this much, which is quite a lot. So that means you can understand you are paying a significant time premium. Volatility is significant as well. The option price in that particular case is $4.59. So you will pay $4.59 for one stock in an option contract. So since the option contract is 100 stocks at a time, so that means you will be paying $459 for one contract. Okay, that will allow you to control 100 shares. So what does it mean in terms of your break even first? So break even wise, it is telling you that your break even point is 13 plus 4.59. That means if Palantir is below $17.59 on January 19, 2024, you will lose money. So you're risking $4.6 per share. Okay, now if you are below $13, that means you will lose all of your money. So now the interesting point here is that what do you think is the bottom of Palantir if things go wrong? If you believe that a stock, because you are risking $4.59, that the decline in Palantir could be more than that, so that means you would limit your downside by buying an option at a $4.59 or $4.6. So that means if company goes in a bad direction, and you say that stock price from 13 can actually go from 13 to 5. So that means you have a risk of $8 if you are exposed to shares. But if you are exposed to options, that means you will never lose more than $4.6 per share because of your downside risk management. So it is important that what is your view on the company and how do you perceive it. So in this particular case, what I'm saying is that the price is 13, strike is 13, and let's say for the time being that we expect Palantir price to go 20 by the end of year. So in that particular case, I go to 20 and I say 300 days from now, let's say 405 remaining days of expiration at that particular point. Let's say by that time interest rate is 1.5. So my 4.5 will be 8.88. So what has happened? Your stock price has changed from 13.13 to 20. That is, so let me just give you a very brief idea. So the 20 divided by 13.33. So the stock price has actually increased by 52%. However, your option price has gone to 8.89. from 4.59. So while the stock price only appreciated by 52%, your option has changed by 93%. So you see there is an inbuilt leveraging effect, same kind of leveraging effect that one would try to build using margin sometime. Now the good part in this particular case is if things go wrong, you already know what your maximum loss look like. Your maximum loss is practically 4.59. Okay, if you are in the margin situation, I mean your margin will keep on declining. I mean your margin situation will keep on aggravating if the stock keep on declining, and you might get margin call and you eventually have to liquidate whole position and you could lose a much more. So in this particular case you get more idea that you have more, if you have a better assessment on the downside production side, if that is your concern. Okay, so for example, if I risk $4.59 and now I can actually start looking, so I will lose money if Palantir is below $17 or $18, I can say, at that particular time. So let's say I say that at that particular point I expect Palantir to go quite high, and let's say 105 days, that means 600 days from now, I expect Palantir price, let's say, to be 40. So in that particular case, my premium, call premium, will be roughly around $27. Just correct it for the interest rate also for the time being. Okay, so that means your $4.59, if you buy a call, you could lose it all. You could lose a portion of it if it is between $17 to $18 at that particular price. And if it goes quite high, you can actually make as much as $27. Okay, if it is 40. So this is why people get attracted towards option, but it's very easy to get overboard when you see that option can appreciate this much. People go all in because assuming that it is going there. See, there is no guarantee where the stock price is going. It's only an assumption and preview that you have in your mind. And you need to understand that any money you spend on buying option, be it call or be it put, you can lose it all, period. If you are okay losing that money and that is your risk management money, only then try to think structuring your options in a longer sense. Okay, so I hope some of this information is helpful. We can also try this information in the same way for a put option also. So for example, let's say I have a view on certain company, let's say Rivian, and I say that Rivian current stock price is 58, strike price is 59. This is how their latest option look like. I say in longer term, okay, so this is the current setting for the time being. Okay, and I, for whatever reason, I believe, let's say that Rivian is overvalued and Rivian is actually going to decline. And I say that my view is that Rivian will decline at least to a price of 40. Okay, so I'm bearish on the stock in that particular case and I'm trying to buy the put. But you see that the price is 58.85. I'm expecting it to decline by 40. That is decline of $18, but the put price is 25. So my premium is higher than my view about the company in that particular case. So I find it very difficult that there is no point of buying a premium put at that particular point. The question in that particular case you can ask is, do you expect it to decline further, like faster? So for example, you want it that reality can happen far earlier. In that particular case, you see that the put price is $19 and it still doesn't make sense. So what is happening in my mind is not what the view you have of the company. It is giving you a bit of a quantitative measure. Does it make sense to risk your money for that particular scenario? So now let us take another scenario, and actually this is quite important one because let's take the case of SPY. So let's take this case of SPY, and let's say we're expecting the Russia, Ukraine and Fed induced inflation measures that could affect negatively on the indexes. And there is a narrative that can also explain at some point of time that there could be a decline in the indexes. So let's say we are looking and we want to protect our portfolio around it. So currently the SPY is somewhere here, the strike price is this much, and we're saying that there is a fair chance that there is a downside risk in the SPY for next 12 months. So we go, and you can see it's one of the most popularly traded stocks, and let's say we select March 17. So at that particular point, and if I update it for 1.5% interest rate also, it is telling the option value. Okay, it is telling that the put for March 17, 23 is nearly $40. That means if I expect the S&P to dive below more than 10% or this strike price, only then I'll be making roughly money somewhere around it. That means SPY has to decline below 440 minus 39.69, say 40 at this particular time. That is 440 minus 40, that is 400. So if SPY declines below $400, then I'll be making some money. If it is 398, then I'll be making $2 per share. If it is 396, then I'll be making $4 per share. So now let's check. Okay, so I'm expecting that towards the end, that is like just before the expiry, okay, I expect that it will decline a lot, and at that particular point it will be, let's say, 360 or somewhere before that. That's okay. So if that happens, you can see that your put will be priced at $80. So you spend $40 and your gain will be $80. That means almost 100%. But in order to that to happen, the S&P has to decline from 440 to 360. Now at this particular point, and later on we will cover on the probability under curve idea, like how do you assign the probability of success and failure to build a strategy around it. But that's for a later date for now. But you can actually see, and now you can sit back and see, do you really see S&P to decline by that time? Is it fair to risk $40 on S&P to make that kind of money? Okay, now this is your personal risk appetite and your personal view about the stock market and how it is going to behave. I mean, in short, what I'm trying to explain with this tool is that it is connected with the market data. You can actually go and put your ticker, extract the data. You can play with the price and the strike price. You can play with the expiration date. You can play with the volatility. You can play with the interest rate environment. And it actually gives you an idea that how your option price, whether you're buying or selling, in case of call and put, it changes under those circumstances. So you can try to simulate some scenarios which you have seen in past where you fail to understand that how the option pricing moved despite the stock price moved in the same direction or the same way as you expected. Option strategies are far more complex thing. Okay, you need to ensure first you understand some of the basic part of this table. Don't worry about this thing which we call like the option Greeks. It is to be covered at a later date sometime if there is an interest on that. At this particular point, your interest is, if I'm buying an option, having a certain view about that company going up and down over a certain length of period in a certain interest rate environment, what would be the option price will look like in that scenario. So if that is the question, then it is quite a good tool to actually go and use it for your help. You can use it for ETFs, you can use it for different companies, and you can customize it, as you can see, based on your length, price and strike. So I hope it is useful in that particular case. Let me know in your comment section if it helped you and you liked it. If you're already an option expert, I don't think you need it. You have better tools which we can discuss also moving forward. If option is something that you are interested and you really want to be good at it, you need to understand, you need to take deep dive. There are no shortcuts for option. If you want to follow me for buy and sell signal for options, trust me, I'm not going to give you one. Okay, the only thing I'm trying to help you in the option learning case is to help you understand that how to calculate your risk and exposure, what are the different mechanics of different strategies that can actually help you to improve. At the end of the day, what option you buy, what option you sell, what money you make, what risk you take, it's all on to you. Okay, I hope this discussion was helpful. Thank you and see you guys next time.